Big headline: the Philippines just sprinted to the front of Southeast Asia's growth pack. Last year, Manila outpaced Vietnam and Malaysia to become the region's fastest-growing economy. And it even nudged past Thailand in total national income. According to the World Bank's newest data, the Philippines now ranks second in accumulated national income in Southeast Asia, trailing only Indonesia. Let the numbers speak. The Philippines posted a gross national income of $518.1 billion, beating Thailand's $510.2 billion. Behind them are Vietnam at $453.5 billion, Singapore at $451.2 billion, and Malaysia at $414.9 billion. Still towering over everyone is Indonesia, with a gigantic 1.39 trillion GNI. So, what's powering this leap? And why is the Philippines' GNI noticeably higher than its GDP? Something you don't see in the other big ASEAN economies. First, a quick explainer because this distinction matters. GDP measures the total value of goods and services produced inside the country, like a snapshot of domestic output. GNI starts with GDP, but then adds income earned by residents abroad and subtracts income earned in country by foreigners. In short, GNI captures what a nation's people earn worldwide, and not just what's churned out within its borders. In 2024, the Philippines' GNI exceeded its GDP by $56.5 billion. A meaningful gap, and a sign of how plugged in Filipinos are to the global economy. The main turbocharger behind that gap: overseas Filipino workers. In 2024, remittances hit $38.3 billion, up from $37.2 billion the year before, roughly a 3% rise. Those cash transfers now represent 8.3% of GDP and 7.4% of GNI. That's not pocket change. It's a structural force in the economy. Even more telling, about $34.5 billion of those remittances flowed through formal banking channels, showing improved financial inclusion and smoother money movement. The bottom line is that while local production is growing, Filipinos working overseas generate an outsized slice of the country's wealth, and those earnings are lifting national income in a big way. Coming up next, how government policy, investment, and domestic reforms are stacking up alongside remittances to amplify the Philippines' rise. Stick around. The best part is what happens when these forces meet. Unlike its neighbors, the Philippines hasn't just banked on factories or foreign direct investment. It's leaned on its people, everywhere. Nurses in New York, seafarers in Rotterdam, engineers in Dubai. Filipinos abroad are earning dollars, euros, and reals that flow home and lift households, local businesses, and even national policy. That global paycheck makes the gap between GDP and GNI so telling. It suggests the Philippines is building a different kind of resilience, one that depends on worldwide engagement as much as local output. If this pattern keeps up, Manila's regional clout could grow even more. Sure, a remittance-heavy model has risks. It ties the country to job markets beyond its borders. But it also opens doors. Invest in education, protect migrant workers' rights, speed up digital remittance channels, and keep reforming the economy. And those overseas earnings can fuel something bigger. Who knows? With the right moves, the Philippines might not just stay ahead of Thailand. It could close the gap with Indonesia one day. Remember, those billions aren't abstract statistics. They're dinner on the table, school fees paid, small businesses launched. In 2024, most of that lifeline came from a few key countries, led by the United States, followed by places like Singapore and Saudi Arabia, with the US topping the list of cash sent home by overseas Filipino workers. Globally, the Philippines ranked fourth in remittance receipts in 2024, pulling in about $40 billion. Only India, 129 billion, Mexico, 68 billion, and China, 48 billion received more. Pakistan followed the Philippines with $33 billion. That lofty spot is more than bragging rights. It's proof that Filipino workers abroad are a central pillar of the nation's economic health. What bumped remittances up? A few forces. Job market rebounds in host countries across the US, Middle East, and Asia Pacific, rising wages, and at times a weaker peso, which makes every dollar convert into more pesos and can nudge OFWs to send extra. But this balance is fragile. Economic slowdowns or geopolitical shocks overseas could quickly reverse the trend. Looking to 2025, experts expect remittances to keep rising, but modestly, assuming the global economy doesn't wobble. Those steady inflows will keep household spending strong. Crucial for the Philippines, where consumer demand and services, not factories, drive growth. Services now account for over half of the economy, outpacing agriculture and industry combined. Check this out. By early 2025, the Philippines economy wears a clear service sector crown. Services make up 62.2% of GDP, industry about 29.5%, and agriculture, forestry, and fishing just 8.3%. Leading the charge in services are IT and business process outsourcing, IT BPO, and the huge economic role played by millions of overseas Filipino workers. Together, those service exports, think call centers, software support, and remittance-fueled consumption, represent roughly 20% of total GDP. That's huge. It shows the Philippines isn't competing on factories and freight alone. It's winning on people-powered services that sell labor and expertise across borders. Remittances aren't just cash transfers, they're social infrastructure. Millions of Filipinos abroad send back much more than money. They deliver stability, opportunity, and the kind of predictable household spending that keeps markets humming. In 2025, the IT BPO industry hit a major milestone. 2 million people employed, producing around $40 billion in revenue, roughly 10% of the global BPO market. That's a serious slice of a multi-trillion-dollar sector. On the remittance front, the World Bank pegs inbound cash at about $40 billion in 2025, driven by an estimated 11 million Filipinos scattered worldwide, more than 10% of the population living abroad. The biggest senders? The United States leads the pack, followed by Canada, Saudi Arabia, the UAE, and Japan. That diaspora isn't just big, it's everywhere, and it underpins household consumption, small businesses, and long-term stability. Put those two forces together, a booming IT BPO engine and steady remittance inflows, and you get a country uniquely plugged into the global economy. Experts expect this combo to push growth, raise per capita incomes, and improve living standards over the next decade. More access to education, healthcare, and upward mobility for millions of Filipinos. This momentum could rewrite poverty in the Philippines, pulling millions out of extreme hardship and remaking the country's social map. What's driving that confidence? A potent cocktail. Steady remittance, inflows from Filipinos abroad, a booming IT BPO engine, and a tourism rebound that's finally firing on all cylinders after pandemic disruption. Together, they're laying the groundwork for broad-based, long-term growth that includes ordinary families, not just big corporations. But there's more than just services and cash transfers. Big-ticket US investments are lining up too, and they could be transformative. Philippine firms holding concessions in the South China Sea are actively courting American partners to tap oil and gas reserves, a move that could strengthen energy security and open new revenue streams. Washington is also doubling down on semiconductors and IT BPO, two sectors where the Philippines already shows real momentum. One of the bolder proposals on the table, a partnership with Seattle's ultra-safe nuclear corporation to roll out small modular reactors, clean, compact power stations that could change the country's energy game if they get traction. Layer that on top of sound reforms and resilient growth, and you've got the ingredients for the Philippines to emerge as a top-tier investment destination in Asia. Hard numbers back the optimism. The Center for Economics and Business Research projects the Philippines will be the 23rd largest economy globally by 2039, one of only three Southeast Asian countries expected to crack the top 30. That's a big deal, but it doesn't mean the road will be smooth. Global shocks, geopolitical flashpoints, and the need for continued domestic reform will all test the country's progress. Still, the Philippines has a powerful hand to play. A young, adaptable workforce, an unbeatable strategic location, growing service industries, and bold new energy projects. Put all that together and the country isn't just growing. It's preparing to play a much larger role on the world stage, drawing investment, spawning jobs, and lifting living standards for millions. Zooming out. In Southeast Asia's rising ranks, Indonesia sits at 10th globally, the Philippines at 23rd, and Vietnam at 25th. Proof that Manila's climb is both impressive and persistent, even amid global headwinds. A new report surveying nearly 200 economies says the Philippines' climb isn't just about bigger numbers. It's proof that the country is becoming tougher and more competitive where it counts. What's powering this surge? Strong consumer demand at home, steady remittances from Filipinos abroad, and a fast-growing, ambitious workforce ready to hustle. Put those together, and the outlook gets pretty exciting. Forecasts show the Philippines jumping 10 ranks over the next 15 years, meaning it'll leapfrog regional heavyweights like Thailand and Singapore and cement its place as Southeast Asia's second-largest economy behind Indonesia. Even bolder, S&P Global Market Intelligence predicts nominal GDP will hit $1 trillion by 2033, putting the Philippines in the same elite GDP club as Asian powerhouses. Look at household wealth. 2 decades ago, the Philippine GDP per person was under $1,000. By 2022, it climbed to about $3,500, and experts expect per capita income to top $6,000 by 2030. A sign of a swelling middle class with real buying power. That's not window dressing. It translates into booming demand for housing, services, retail, and entertainment. And that spending becomes the engine for even more growth. So, what's the spark? Private consumption. Everyday Filipinos upgrading their lifestyles. As urban jobs get better paid and more people move into cities, their spending ripples through the economy and creates fresh opportunities for businesses and investors. The Philippines is no longer merely catching up. It's reshaping its economic destiny. For investors, entrepreneurs, and anyone watching Asia's rise, Manila is fast becoming a market you can't ignore. Which sectors will ride this wave hardest, and where should investors and policymakers place their bets? Stick around. Look out, Asia. The Philippines is gearing up to be a heavyweight. We're not just talking buzzwords or momentary spikes. This is a long-game projection. By 2050, analysts at London-based Capital Economics reckon the Philippines could sit at number 18 worldwide, a leap that would reflect decades of steady gains, a swelling middle class, and a workforce getting sharper and more productive. We're talking serious scale, a projected $4.86 trillion in nominal GDP and GDP per capita, climbing to roughly $33,650. That's a dramatic upgrade from today, the kind of change that rewrites how investors and nations see Manila. But here's the catch. None of it happens without fixing one basic bottleneck: infrastructure. Get this right, and everything else accelerates. Fail to build roads, rails, power, and ports fast enough, and growth will hit a ceiling. The good news? The Philippines already has a reform roadmap and momentum. With that, the country is targeting a massive $100 billion in fresh investment over the next 5 to 10 years, with big checks expected from global heavyweights like the United States and Japan. Where will that money go? Everywhere that matters: energy, semiconductors, major transport links, and the digital economy. Japan, in particular, has been a steadfast partner. Just look at the Metro Manila subway and the North-South commuter railway. Together, they top $25 billion, and Japan is footing over 80% of the bill. That's more than financing, it's a confidence vote. Meanwhile, U.S. investment is pouring into semiconductors and the booming IT BPO sector. Industries already creating jobs and exports by the truckload. Add potential energy projects like small modular reactors on the horizon, and you start to see how the power mix and industrial base could transform. There's also a geopolitical twist that could speed things up. As tensions simmer in the South China Sea, especially around the West Philippine Sea, multinational companies are rethinking supply chains and diversifying away from China. That shift puts the Philippines in a prime position to capture new factories, chip fabs, and logistics hubs from firms looking for safer options. With a young population, a strategic location, and growing ties to the world's major economies, the Philippines has the ingredients to move from emerging to essential. Nail the infrastructure and policy reforms. Channel that $100 billion wisely, and the next 3 decades could see Manila become a top-tier economic magnet across the Asia-Pacific.